Hey, Neil.
Hey, Serena, how's it going?
Good, good. Music is still good.
I like it.
Yeah.
We still have 4 minutes before the top of the hour, and we'll go ahead and
Okay.
get started. Remind me to hit the record button when the thing actually starts.
Okay. It's very relaxing.
Yeah, I like relaxing.
Yep.
I'll be right back.
Okay. So, Neil, I'm gonna send you that list of clients' questions.
Okay. All right, we're almost there.
Yep, yep.
15 seconds. Oh, I guess we can start 15 seconds early.
Yeah.
All right. So I turn down the music here. All right, welcome everybody. Oh, I reminded myself, gotta hit the
The
record button.
record button, yes.
Yes. All right, now we're recording. Welcome, everybody. Today is, what is today? It's March 5th, 2024, and it's time for office hours. So, oh, I meant to clear that out. I'm gonna clear the annotation, delete. There we go. Because we're actually getting started. This is Tech Sherpa Live. We're doing office hours Q&A. Every Tuesday we do something, and this week it's going to be, open questions, basically,
Mhm.
and open answers. Now, next week's gonna be different. Next week, I'm doing a case study on 5 tax tactics to save $32,864 in 2024. And this is a case study on a client that we had recently that, we analyzed our situation, saw what was going on, put into place 5 different strategies, and that's the number that came out as far as tax savings. So if you are interested in the nitty-gritty how-to, definitely tune in next week for that one. And that'll be good. That'll just be me talking mostly, rather than the open Q&A. But sometimes we have time for questions at the end, sometimes we don't. Um, but don't count on it, basically. But for today, we are doing the open. So let's do a couple intro things here. I'll just run through briefly. And Serena, you can see my screen, right?
Yep.
Okay, great. So that should be going out on the interwebs onto Facebook and YouTube and what else we do? LinkedIn, all
Yep.
that jazz. All right. So here's me, my story. So I'll give you the highlights, basically. I was in engineering school back in 97 to 2001. And in the spring of 2000, I was interning out in Texas for AMD, which is Intel's competitor. They make computer chips. And I happened to be there during the time that they launched the first 1 gigahertz processor. And that was a big deal. They beat Intel to the punch, which was the first time they'd done that in decades. And it was, stock went to the roof and, everybody was happy. It was the dot-com boom era. It was like the last gasp of that before the crash. So it was a great time had by all. And I thought that's what I was doing with my life. So, I went to engineering school, I was getting bachelor's in electrical engineering, did like computer design stuff, is all kinds of stuff. And so then at the end of the term, the whole company is having an award ceremony. And because we had this big event with the 1 gigahertz processor. So, they're saying, all these people did all these things during the last, quarter or year or whatever it was. And at the very last one that they brought up, which I always in all my stories, everybody's named Bob, Alice or Bob. Those are your two choices if you're gonna appear in one of my stories. So Bob, their senior vice president of whatever is up there, and he's talking about how Bob's such a great guy. Bob had a European vacation, 2 weeks booked with his family, approved months in advance, but it was crunch time here at the company, and so he canceled his vacation and he came into work and we got the job done. We got product shipped. Isn't he such a great guy? Everybody's clapping. And it was at that moment that I realized I can't do this. This is not going to work for me. So that's not the kind of life I want to lead, where I have a European vacation booked with my family and I cancel it to go into work. So, my plans that I had built over the last however many years were out the window, and I started searching for other things to do. And so I went on my own little entrepreneurial journey, and that had ups and downs. And like a lot of entrepreneurs out there, I really had no idea what I was doing. And to the degree that by 2007, I started getting letters from the IRS saying that I owed them $1.3 million in taxes. So if you have gotten letters from the IRS, I feel your pain. I know what it's like. I've been through the whole thing myself. First, you get letters, and then if the number's big enough, this is how it happens. First, you get letters, then you get certified mail letters, then you get phone calls, and then if you ignore all of those things, which takes a process of years, if you ignore all of those things, um, then you'll get garnishments, where they will go after whatever assets they can find of yours, houses, boats, real estate. Now, I had nothing, so there was nothing for them to get. But they did start garnishing my paycheck because I was working for a company at the time. And so my paycheck went from whatever it was every 2 weeks down to like $300. And that got my attention because, well, it couldn't pay rent. So that was kind of a problem. So I then started casting about trying to fix my own problem. And the I ended up hooking up with this former Wall Street tax attorney. And he helped me go through my problems. That whole process took about a year to clean up, because it was a whole thing where you got to get transcripts and then you got to file amended returns. Actually, in my case, it wasn't amended returns; they were original returns. That was my whole problem. I hadn't filed because I thought I didn't need to. That is not true in most cases. Some cases it's true, but in my case it was not. And ended up cleaning up the whole thing. And so then I that was my introduction into the tax world. And uh, you know, this mentor of mine, he kind of put me through this kind of old school apprenticeship kind of um, you know, I don't want to call it ordeal. It wasn't like unpleasant or anything. It was a hell of a lot of work. But you know, he needed help. His business was growing. I took all the entrepreneurial lessons I'd learned over the last decade and started applying them to his business because he was terrible at the entrepreneur side. He was great at taxes. And we tripled his business over the next couple of years. I was working 100-hour weeks for like a decade, and you can see here 50,000 tax returns, billions of dollars worth of revenue, and all that kind of stuff. So it's been a journey. And what I didn't know at the time when I first got into this whole tax thing was that the the average taxpayer out there has no idea what's possible. And the average tax preparer that they go to has no idea what's possible in terms of tax strategy. So when, in my mentor's firm, it was all tax strategy because that was his approach, so he was, former Wall Street guy. He was actually involved in, if you're familiar with 1256 contracts and the 40/60 long-term, short-term, or short-term, long-term capital gains treatment. He was instrumental in creating that because of that's how they had some tax strategy for the specialists on the New York Stock Exchange back in the 80s. So that's kind of the environment I grew up in the tax world, which, like I said, I didn't know till years later was not what most people do in the tax world. So, I started Tax Sherpa back in 2019, really opened the doors like officially in 2020. And, Tax Sherpa is here for, my tribe, the people who also couldn't get a job because they're just like not willing to play the corporate games and not willing to cancel their, European vacations with their families. So it's those small business owners, independent contractors, solopreneurs, those group of people who want to get their quality of life back. Because what happens is when you are paying taxes, you are effectively working for the government. And, you know, to some degree, that is required if you're going to make money. If you're not going to make any money, you don't have to pay anything, and we can show you how to do that. But if you're going to make money, if you run a consulting business, if you are a graphic designer, if you are, anything that is related to mostly service businesses, because service businesses are great in that they have high margins, and they're terrible in that they have high margins. So they tend to have the most tax issues there. And so what we do is we help you structure your business in order to save tons of money on your taxes and get your quality of life back, because then you're not spending that time working for the government, you're spending it working for yourself, which is the name of the game. The more time that you can spend working for yourself, I'm going to argue that the happier you will be and the more profitable you will be. So the goal is to not only make a bunch of money in doing whatever you do, providing service for people, but also to keep it. And that's sort of how we come into the picture. All right. So this is I like this every time I read this quote, I like it more and more. The quality of our questions determines the quality of our life. And so, at the very root, what quality of our life do we want to have? Or what quality of life do we want to have? That's kind of the question. So here's my question. What is the root problem with overpaying on your taxes? And I hinted at it already, but here's my answer. Basically wasting 74 days a year. That's the fundamental root problem. Is that if you're going from paying 35% in tax to 15% in tax, that's a 20% difference. So 20% of a year is 74 days. So if you don't if you don't focus on what you're doing and you don't put into place the strategies that are available to you, then you are giving away 74 days each and every year. And that's an average. Okay. So your number is going to be different, but broad average, you're giving away 74 days a year to the government just because, just because, you know? So I think that is a horrendous waste of not only resources, but of life. And that on a deep philosophical level offends me. So that is the core problem, and that's what we want to fix for those people. Now, I will say, if you are a high paid W-2 earner, and we've seen a few of these over the last couple of weeks, if you're a high paid W-2 earner, to a certain degree, they've already got you because of the current withholding act. You know how they take taxes out of your paycheck up front? That's how they get you. Now, in the old days, before 1943, that wasn't true. Everybody paid their taxes at the end of the year. And then World War II came in and people weren't paying to the speed or degree that the government wanted. And they passed this current withholding act and they started taking taxes out up front. And once they did that, then, there's a lot less flexibility you have. And then over the years, there has been a lot of tax reforms. There was the 86 reform, there was the 2017 reform. There's always little changes. But more and more, the tax deductions for individuals, so your 1040 filings, have been stripped away more and more. And the tax strategy and advantages have gone towards the businesses. And that's just been a trend that has continued to be true for, we're 109 years into this income tax thing in America. And that's been a continuing trend for 109 years. And I don't really expect that to change all that much. So, that is the root problem, and that is the answer to the root problem, is wasting 20% of your life, 74 days a year, each and every year. All right. So everybody has questions. I know that. And I have the answer to every tax question if you're ready. Serena, are you ready?
Yes, ready.
The answer is it depends.
It depends. Yep.
And I know people get frustrated with that because it sounds like a cop out, but it's actually true. It depends because everybody's facts and circumstances are different. And those are key terms, facts and circumstances. If you talk to a lawyer, they'll talk about a fact pattern, same kind of thing, where, what is true and what rules apply to your situation is not going to be the same as somebody else. And, everybody's situation is different. That's why everybody has a different tax return. So I saw something or other um, last week about how, it's one of these memes where, they were saying it's tax time, it's tax filing time. And, there's one guy who's the IRS says, hey, you got to file your taxes. And then the other guy just switches to a regular person. Is like, oh, okay. So that's voluntary, right? And the IRS says, yes, it's voluntary. But if you don't, we'll throw you in jail. Then he goes back to the taxpayer and he says, okay, so you'll tell me how much I owe, right? And the IRS says, no, no, we're not going to tell you how much you owe, but if you get it wrong, we're going to fine you.
Oh gosh.
And then it goes back and forth like that a couple times. And it's like, I understand the sentiment, obviously. But and then in the comments of these things, you'll see people's like, oh, we should just file, um, the government already knows how much money you have. They should just file a tax return for you and blah, blah, blah. And what these people don't know is that actually already happens. So if you don't file for a couple of years, you'll get what's called an SFR, a substitute for return. And the IRS will compile whatever information it has about you based on third-party sources like W-2s, 1099s, and all that kind of stuff. And they'll create a pro forma tax return inside their computers. And if that calculation comes out where you are due a refund, you will never hear from the IRS. And then if you owe money, then you'll start getting letters, which is what happened to me in 2007. So that process takes a couple of years because they give you like a grace period basically to get it done. And but then if you don't, they do their automatic calculations. And you'll see things like in Irish transcripts, it's like, tax per computer. And it's the worst way that you can file a tax return because they assume a baseline of nothing essentially, and maximum taxable income. So the complexity of the U.S. tax return or the U.S. tax filing system is there, and the complexity of the tax return itself is there to allow you to pay less in tax. So Congress creates the law, and then there's all the subsequent laws that create exceptions and carve outs and whatever. And where your job is to figure out which of those laws. Apparently, raising my hand. Which of those laws, which of those regulations apply to your situation, and how you can enact them and structure them in a way to make your tax liability as low as possible. Now, if you're a highly paid employee, you're limited upfront, and that is by design. If you're a business owner, you have a lot more power to adjust things how you want, and that's really what it comes down to. But everything depends on your particular situation. What is true for you is not necessarily true for others. So, try to think of a funny example that's appropriate because my favorite example of this is with an adult dancer, but I don't want to get into that right now. So there was a similar kind of story with a guy who had a boat, and he was in marketing, and we were discussing as to whether or not the boat was a business expense because he put it in his ads, right? And so the question becomes, it's like, well, maybe it's a business expense or maybe it's a business asset. First, how is it titled and all that kind of stuff. But then second, in what way is it a business expense, right? And he was actually able to demonstrate that when he started putting the boat in his ads, as far as like, you too can live the financially free lifestyle, whatever the influencer model kind of stuff. He was actually able to demonstrate a drop in his CPM, his cost per thousand, as far as ad displays. So there was um, a tangible result in his business for the for the implementation of using this asset. So for that degree, and then you got to separate personal versus business and whatever. But for that, you can make a solid case that this is a business expense or a business asset. And if you just have a boat to go fishing on the weekends and you do nothing with your business, well, that is not a business asset. So, same boat, oh, baby, same money, different treatment because different things happened, different facts and circumstances. So that's just one example, and literally there's a million of them. We had one guy. This was years ago in the 2008 crash. He had a several real estate rentals. I think it was five or six of them, and he ended up losing his shirt on all these rentals because the market crashed. He had these mortgages, yada yada yada. And so we had to go back and forth with the IRS for like a year over whether this was a capital loss or an ordinary loss. And the difference is like, is he engaged in the trade or business of rental real estate? And we argued that yes, if you have five or six properties, that's a business. It's not even one is a business really, but the way they look at it is more conservative because there's different rules for capital losses and ordinary losses. And we had to go back and forth, and we had to get out the IRS publication. I remember I found that there's like three different publications that we used, and I would highlight the language in the various sections that we were demonstrating, and hand that over to the revenue agent. And finally, we won our argument. But I remember this woman saying to us on the phone, after getting one of our responses, it says, "Well, I conferred with my colleagues, and they said that it's capital." And I was raging because I confer with my colleagues is not an argument. That's, that's not a reason for anything. That's that's just I don't know the law, and I, you know, asked Joe down the hall, or Bob. So that was a very frustrating experience. But we ended up proving that in this guy's facts and circumstances, this was an ordinary loss. He's entitled to the deductions. Go pound sand, basically. that was that was a that was a frustrating one, but we did finally get that resolved. Let's see if I can put my hand down. Hold on a second. I don't know how to do this. Where's the emotes or whatever? Let's turn that off. Reactions. I don't know how to get this to turn off. Anyway, all right. So with all that said, Serena, why don't you hit me with one of the questions we have lined up? And if people throw questions in the chat, whichever platform you're on, hopefully we will see it. Or we use Restream to patch into all the different services. So we will try to get to those if possible, but we do have a bunch queued up. So, Serena, what do we got first here?
So we had a client that asked, so the question they had, which was, should I consider converting my traditional IRA to a Roth IRA?
That's as a real it depends. So, the answer is it depends. And here's what
Right.
happens. When you contribute to an IRA, a traditional IRA, then you get a tax deduction. So, pick a number, you put in $5,000, and then you get a subtraction from your income of $5,000 in that year that you contributed. Now, the flip side of that deal is that you put it into this account, it grows, it does whatever it does, whether you have a brokerage account in an IRA or if you have a self-directed or whatever, it's doing whatever it's doing. And then come retirement time, you start to withdraw from that. And if you wait long enough, they will force you to start withdrawing from it because when you withdraw from it, then it becomes taxable at that point. So you get the $5,000 deduction on the current year, and then you get the whatever the amount ends up being, 5,000, 50,000, depends on how the account did over time. Um, and when that money comes back out, it's taxed just like any other kind of ordinary income. So, you are the speculation. If you talk to financial planners, they will say it's like, well, that is true, but you're going to be in a lower tax bracket when you retire. And that is an assumption. And it assumes two things. So one, that your spending goes down because kids are out of the house and your mortgage is paid off and all that kind of stuff. Those things may or may not be true. One, and then two, you're speculating on what the tax rates are going to be in the future. And maybe they're higher, maybe they're lower. Tax rates change all the time. And the brackets at which those tax rates apply change every year because there's inflation adjustments. And some of them are realistic and some of them are not. The last one we had for 2024, not realistic. And we can get into the math of why that is, but just take my word for it. The bracket changes do not reflect the inflation numbers from the government published over 2023. Anywho, so we know that the tax situation is going to change in the future, and you are guessing that it's going to work out to be a benefit on a time value of money kind of basis because money now is worth more than money later. So that's how the traditional works. Now, a Roth IRA is similar, but there's no tax deduction on the front end and there's no tax on the back end. But still, you put money into a special account, can't touch it till you retire, and then you start withdrawing money. But because you didn't get a tax deduction on the front end, you don't get a tax hit on the back end. So it's just even Steven, right? I put in $5,000, it grows hopefully and does whatever it does, and then I start drawing money out and it's tax free. That's the idea. So a lot of people, since the Roth came out, because the traditionals were the original, and then Roths came out 15 years later or something. A lot of people say that you should just do Roths, and then you avoid this whole speculation problem. And yes, you lose out on the tax break on the front end, but if you do the math and work in certain market assumptions and all that kind of stuff, it works out kind of okay. So it's you whichever way you go is going to depend entirely on what your future assumptions are. What is the market going to do? What are your investments going to do? What are tax rates going to do? What is your spending going to do? All those things. Now, if you decide to go from traditional to Roth, what happens is you do a rollover, but it's a taxable rollover. Because you got that tax break originally, when you do the conversion, you have to take the tax hit then. So what a lot of people will do is they'll have, like a 5-year plan. So, okay, I have $100,000 in this IRA. I'm going to do $20,000 a year just to make it not so painful, and we'll roll over to a Roth, 20,000 each year. That's fine. You can do it. Um, and you know, it depends on what your assumptions are with all those different forecasts. What some people have done, especially business owners, one of the major differences between business owners and regular employees is that business fluctuates a lot. So some years you have good years, some years you have bad years. So for me, 2020 was a good year. I paid a lot in taxes. 2021 was a terrible year. So I got sick, I couldn't work, it was the whole thing. Um, and so I had a low income year. And the if you have those kind of situations and you have one of these pending conversions, a lot of people will take advantage of that lower year and say that, okay, well, my tax bill is lower this year, so I will take this opportunity in order to do a Roth conversion and take that tax hit on a lower starting amount compared to those higher years. So that's a strategy that works. But fundamentally, you are trading a tax hit now for a potential tax hit later. So you can define the impact now versus the unknown later. So there's that element to it as well. So is it a good idea or not? I don't know. Talk to your financial planner.
It
But that is
depends.
it depends, but that's the mechanics of how it works. So you gotta work through all those different scenarios and see what makes sense for you.
Okay, sounds good. And then so we have another question from a client, and they're asking, what's the best way to manage capital gains or losses?
Well, kind of related to the story I was telling earlier. So we'll start with the losses. So capital losses are vindictive. That's the best way I can put it. So if you have a capital gain, so that means you sold an asset like a stock or a piece of real estate or something that has long-term value. And if you have a gain, whatever the amount of that gain is, you owe tax on it. So if you make 100 grand on you bought Tesla calls or whatever, and you had a good year, then you owe money on the whole amount. If you have a loss, you don't get to deduct it against other things. You can only deduct up to $3,000 per year. So for me, I have like 100,000 capital loss that happened in like 2003 or four or something, and I can only write off $3,000 a year every year. So it's been going for almost 20 years now, and I still have, another 10 or 15 years left on this amount that I'm writing off at $3,000 a year. It's just craziness. So, you would think, in all fairness, if you're taxed on the gains, then you can take deductions on the losses. However, that's just not the rules because, Congress makes the rules. And they decided that, well, if we allow people to do that, then it'll be too incentivized to lose money and all this kind of stuff. So basically, they artificially limit you. So if you have a net capital loss, that you get to write off $3,000 a year, and then the remainder rolls over to the next year. And it will keep rolling over either until you use it all up or until you have gains from something else to offset. So that's kind of the mechanics of how it works. Capital gains separates into two parts: short term, long term. Short term is a year or less, long term is over a year. And the short term capital gains is the same tax rate as whatever your ordinary income is. So if you are in the 32% bracket or the 24% bracket or whatever, then that's going to be the tax that you pay on that short-term capital gains. Long-term capital gains has a preferential treatment. It's always going to be less than your marginal tax bracket. So if you're in the 24% bracket, it doesn't quite line up like that, but if you're in the 24% bracket, you're going to pay 15 or 20% on your long-term capital gains. So, long-term capital gains, depending on your total income for the year, is going to be either 0%, 15%, or 20%. Then on top of that, if you're over like 250K, then there's a net investment income tax, which was one of the Obamacare taxes. That's 3.8%. And then if you're in a state with state income tax, then you're going to have a state tax. Some states just applied the same rates to all income, and some will have preferential rates for ordinary versus capital. So you have to look at whatever state you're filing in. So those are kind of how it all works. So some of the strategies around capital gains are that is the most basic one is tax loss harvesting. So tax loss harvesting is what happens when you have gains and you've recognized the gains, you've sold whatever it is, and you have a gain of, I don't know, pick a number, $10,000. And then you also have these other things that are in loss, but you haven't sold them. So the tax loss harvesting is you look in usually December, maybe November, and you say, okay, well, I've got these losers in my portfolio. If I sell these now, that will offset the gain from this other thing that I have. And you have to have the gain first. That's kind of the main thing, or you do it at the same time. But you don't do tax loss harvesting in anticipation of gains. So you have gains, either booked or about to be booked, and then you look at your losers and say, well, which of these can I sell to reduce my net gain, or eliminate it, depending on the numbers. So that's a basic strategy. If you have a loser that you want to still stay into, there's a rule called a wash sale rule, meaning that you can't just sell it and then buy it right back, because effectively they discount the sale entirely. So what happens is that you have to wait at least 30 days in order to buy back the same or substantially similar, um, you know, asset. So, like if you sold, let's say you were holding Pepsi stock and you sold it for a loss to tax loss harvest, you could not then turn around and buy Coke because it's too similar. You might be able to buy an ETF that contains Pepsi, maybe, depending on what other things it has in it. But otherwise you'd have to wait 30, 31 days and then buy your Pepsi back. And obviously the market's going to shift during that time, but that's just part of the game. So, that's sort of basic strategy number one, dealing with capital gains. Depending on the type of asset that you're selling, you might be able to put it into an installment sale, where you take the sale over time. You might be able to do a deferred sales trust. You might be able to do a 1031 exchange if you're doing real estate. So there's a couple strategies related to dealing with capital gains and delaying or deferring the taxes as qualified opportunity zones. But the problem with all of those strategies is that they all require you to not take the money. You got to put the money into something else. So, or wait for it, in like a deferred sales trust. So, most people when they're selling something, they want the money, and that's the crux of the whole issue. So if you want the money, then basically your only real option is to look at tax loss harvesting, or other kinds of ordinary losses that will lower your overall, taxable income. Um, and there's a million other things you could do to create ordinary losses. But as far as capital gains specifically, that's kind of the general field we're playing in. So tax loss harvesting, deferred sales or installment sales, uh, like kind exchanges for real estate, qualified opportunity zones, and that's the basics of strategies to deal with that.
Okay. And so I have another question for you, Neil.
Uh-huh.
It's kind of funny.
Okay.
It's the client asks, "Can I write off my gym membership as a healthcare cost since it keeps me fit for work?"
You know, maybe. So it depends on what you do. It depends on your facts and circumstances. Um, and depends on, what kind of perk plan you put in. So perk plans are a little bit fraught in that there were one of the craziest cases that I saw was actually with the tech companies in Silicon Valley. So they used to provide free lunches and dinners to their employees as just a perk, So then the IRS got involved, and I looked at the case history because we had a client that experienced this. So what they ended up doing was the IRS said, you can't do this. This isn't a perk. This is, basically taxable income that you're giving to your employees. And so what the Google, at least our client worked for Google, what they did was they gave everybody a raise in order to cover the tax that would basically be the impact of the free lunch and the free dinner that they had. So the IRS's rationale was that this is not a perk in that it's unusual benefit, because in the Silicon Valley environment with these tech companies, everybody was doing this. So it's not unique and different. Therefore, it's not a perk. Therefore, it's taxable income, as far as a benefit that you're giving to your employees. So that's a weird argument to make, because like you're just restricting it to this one area, and then it doesn't apply in Indianapolis, because not every company in Indianapolis gives their employees lunch. So there's some weird things you gotta navigate through with that. But um, there's other ways to skin a cat. You could look at, basically, medically required kind of stuff. If you are under a doctor's supervision and it says do this, do that, do the other thing, or physical therapy, that could be a similar kind of benefit, in that similar kind of health benefit, but in one that is required medically, because things that are medically required come under, allowable medical expenses, and things that are elective or voluntary are not in most cases. So, there's some things to do there. Um, and yeah, so you'd have to look at the specific situation, but maybe. Also depends on what you do, as if it's relevant or not. Because there's the whole um, uh, necessary and ordinary expense concept, where if you have your expenses need to be necessary and ordinary to your business. And what that means for your business is going to be different than another business. So, like if you're a personal trainer, then yeah, that's probably going to be necessary and ordinary. If you are, I don't know, like what I do, not really necessary and ordinary.
Yeah,
I sit in front of my computer all day. So, yeah, it's like I said, depends, facts and circumstances.
okay. So it depends, guys.
It depends.
So another client asked about their estate. They wanted to know what strategies can they use to minimize taxes on their estate.
Well, most people don't pay any estate taxes. So, the state taxes are super minimal. Well, that's going to be somewhat changing here in the short term. Uh, so let me think of how I want to explain this. So the state tax, there's a lifetime exemption as far as, and this is going to be mostly true for most states. So like New Jersey doesn't follow the federal, but most states do. So that's something to keep in mind. But basically, they say that, when you pass away, you can leave your heirs up to, X number of dollars and the X changes. And that's going to be under, as long as you're under that threshold, then your state's not going to owe any tax. If you're over that threshold, then it will. And the tax is a lot. It's like 50%. And estate tax returns get audited like every single one. So, it's because, you're dealing with very, very high net worth kind of things. So for the vast majority of people, not an issue because, well, currently the state tax, if you're, it's basically $11 million. And if you're married, then, usually the husband dies first and the husband leaves the wife up to $11 million. And then the wife can leave the kids up to $11 million. So it's 22 between the two. And, those numbers change a little bit every year. And so, very few people are above that. However, in a couple of years, that is going to get cut in half because the provisions for the Tax Cut and Jobs Act from 2017 were 10-year provisions. And, well, it's an open question as to what Congress will do at that point as far as the estate exclusion. Um, so So for most people, they don't have to do anything. Even if that gets cut in half and you're down to 5.5 or 6 million, and then twice that for a married couple, which most people who build that level of wealth are married. You can read Millionaire Next Door for some insight into that, Thomas Stanley's seminal work. But yeah, so of those who do have to worry about it, then well, one, you have to worry about it. Two, there are estate planning firms, law firms basically that specialize in all this kind of stuff. So, but the general idea is that, whatever is in your name when you pass away is part of your estate. So the name of the game becomes to divest yourself of these assets into other entities, charitable foundations, various kinds of trusts. There's a whole bunch of different strategies around it. And again, it depends on your facts and circumstances as to which are appropriate for you. But uh, there's a million different kinds of trusts that the lawyers like to do, and they charge big bucks to set those up. And if it applies to you, then the math works out, but it's still expensive. Like I've seen people charge 100 grand to set up a trust for various different purposes. But yeah, so I mean that's the fundamental idea is you want to not own the things so that your estate, which is, the assets that you held, is smaller than that exemption level or as small as you can get it, at least under the threshold if possible, or as close to it as you can get. And then, that passes to your heirs, either tax-free or mostly tax-free. But yeah, that's a very deep rabbit hole. And people, the state tax is probably the worst tax in my opinion. So basically, because all that money that you um I don't want to say all, but most of the money that gets taxed in an estate tax situation has already been taxed. So, it's real estate, it's stocks, it's whatever, that you've been paying taxes all along the way, typically. There's a small exception where, like, if you built something, whether it be real estate or a company or whatever, that has a great deal of value that, you never sold it, so you never had any tax impact, then those assets were not taxed along the way. So there's some argument there. But by and large, that's not usually what happens. And um, so, you're basically double taxing, a piece of or a set of assets. It could be cash, cash, definitely got to you somehow through some tax mechanism. And that is, um, that is, I think, not justifiable. Also, it raises almost no money for the government. So it's really just a social engineering policy where they're saying, well, people who are heirs to rich people should not, you know, get that level of a free hand up. You can get 22 million, soon to be 11, but above that, then, we're not going to allow that. And there's no real, there's no real principle behind that. It's just we don't want to. It's kind of what it comes down to. Um, so yeah, I'm not a fan of the estate tax. And like I said, some states like New Jersey have lower than the federal. I think New Jersey starts at 2 million. I'd have to check on that. It's been a while since I looked at that. But yeah, it's you might have a state estate tax issue and not a federal estate tax issue. So that's something to be aware of that you should check out. Um, but yeah, that's kind of the short version. And it's estate planning like on that level is not something that I specialize in. That's a lawyer thing. So you definitely want to retain a firm that specializes in that kind of thing if that applies to you.
Okay, sounds good. So we have another question here, Neil. We have a client with a side business. They want to
Mm.
know how does that affect their personal tax situation?
Well, it depends what you do. So side businesses are great, and almost everybody has a side business, whether they think they do or not. Because one of my favorite things used to be back when we saw people in person, pre-COVID, was a new client would come in and I'd just start talking to him, so what do you do? It's like, oh, where we were in Florida, we had a bunch of people who worked at the Hard Rock Casino, which they rebuilt into a giant guitar shape thing. So we had a lot of guys who were working there. We had a bunch of the valets who worked there actually, who worked in the parking lot there. And valets actually make decent money if you're at high-end places. So I talked to them. So, what do you do? Blah, blah, blah. And then my favorite question that I would ask people is say, okay, when you're not at work, what do you do, with your free time? And almost never do I get the answers like, oh, I watch TV. I think I had that answer once. And some people will say that, I take care of my kids. That's takes up all my free time. So, okay. But even in the taking care of the kids, usually there's a spouse that is doing something else. They've got some kind of hobby. So the valets that at the casino, for some strange reason, I don't know why, a bunch of them were into raising, I'm going to call them alternative livestock. So they would raise snakes, they would raise invertebrates like beetles and things like that. We had one guy who grew coral and sold them to people who, do saltwater aquariums and that kind of stuff. And so, like we actually had two different people who raised snakes in a spare bedroom. And you buy a snake, you raise it, it has babies, you sell them. It's like it's livestock, and just for hobbyists who enjoy having herpetariums. Um, and that question that I ask people is like, what do you do when you're not at work? As I've gotten such a range of answers. I had one girl, she was a lawyer, and then in her spare time, she went around to people's houses and taught them how to cook in their own kitchens. It was, just a thing you would not expect, right? And so all different kinds of answers. Um, and so these are all side businesses because you're doing something with the intent of profit. That's what a business is. Whether you make money or not is a separate question. But if you have the intent to make profit, then that's a business. So then the question becomes, okay, well, one, did you keep any records? You should. And two, how are we going to file this? Because what most people do is they will file what's called a Schedule C. So Schedule C is a part of your individual tax return. The title of the form is profit or loss from business. And you can have, you report your revenue, you report your expenses, various categories, and then you have a net profit or net loss at the end. That net profit or net loss gets incorporated with your other income. And then, if it's positive, it's going to add to your taxes. If it's negative, it's going to subtract from your taxes. So that's the very baseline level of things. So one of the things that I talk about is that in order to get the benefits of being a business, you got to act like a business. And that means setting up your entities. That means following through on documentation, keeping books and all those kind of things. Now, I will say, whatever happens, whether you keep records or not, you're still responsible for reporting all income. That's just the law. So you're responsible for worldwide income to the, reporting to the United States. How much that is taxed depends on, all these other factors. But, on the baseline, you would report, your revenue and on a Schedule C, and then that you pay income tax on that and you pay self-employment tax. So we had a client this week where she does part-time bartending. She used to be a full-time bartender, then got married, had kids, and stopped working so much, but still does part-time here and there, right? So, we had to ask her, like, well, did you do any bartending this year? You know, and she said, yes, I did a couple jobs. I made this amount of money, and so we included that on her tax return. In her case, it actually helped because it enabled her to claim more on the credits for the kids. Um, but in other cases, it hurts. So you have to look at how the overall tax situation is impacted by your revenue and your expenses. And we want to make sure one of the things that we do a lot of is we make sure that you are, well, one, documenting everything, but two, that you are taking advantage of all the expenses that you can. Because when you have a side business, people get sloppy and they start paying for stuff personally that is really a business expense. Or maybe there's a thing that is like part personal, part business, and you got to apportion those different things correctly. So we spend a lot of time going through those kinds of things to make sure that you are getting all the deductions that you're entitled to. So new businesses, side businesses, and similar kind of situations often run at a loss because it takes time. It takes time to figure out what you're doing. It takes time to figure out the exact right thing to offer to the market. It takes time to invest in the operations and the equipment and whatever else you have going on. And so it's very common that those first few years are running at a loss. And in those cases, the um, the negative there is actually going to flow through into your personal tax return, whether you do it through a Schedule C or it's a partnership 1065 or an S Corp 1120S, and that will subtract from your other income, your day job income, and that will lower your taxes overall. Now, I'm sure you've also heard the statistic that, 9 out of 10 businesses fail in the first 5 years or whatever the number is. And that's very true. So, um, a lot of those businesses that start, they lose money, and then die. And the corporation is kind of an amazing thing in that it has a legal identity of its own, and it can die without you having to die. So that's a plus. You can try out these things, and if you lose money, okay, you take the tax deduction, and it's the goal is not to lose money, but the goal is to try things and find out what works. Um, one of the things the realizations I've had over the last, I don't know, several years is that yes, most things fail. So most businesses you try are going to fail. Most side businesses you start aren't going to make money. But as long as you have the intent and as long as you keep trying, you'll probably eventually succeed. Because, if you fail 9 out of 10 times, but then that 10th time you succeed, then overall you succeed. But having the staying power to go through all that is the difficult part. Because, well, one, you gotta weather the losses of dealing with that, year in, year out. And two, it's emotionally very difficult to keep trying after you get kicked in the face. So, and very rarely does it take 10 times. It's usually like three or four. So, I've gone through, I don't know how many businesses over the past couple decades, but let's call it 5 big ones and numerous small ones. Uh, and eventually you find out, what kind of works for you. And what's going to work is not just going to be, what is the hot thing right then, but also, what works with your physical makeup and your personality and all those kinds of things. Um, so I mean that's a tangent. I probably won't go down too much more, but yeah. So that's the short version, and I've been rambling for a while, but that's still the short version of you report it in some form, either a Schedule C or as a separate entity, and then in most cases that net profit or net loss is going to get included in your personal income, and it's either going to add to or subtract from your other income. So most side businesses are going to lose money, at least at first. And so that'll end up being a deduction against your other income. And then that will actually lower your overall tax rate.
Okay, sounds good. So I think this is probably our last question, right, Neil? Or what do you think?
Probably so.
Okay, understood. So a client asks, is there a tax efficient way to invest in technology upgrades for my home office, or should I just stick with the basics to avoid red flags?
That's actually a really good question. So, um, the most efficient way to do it is with an accountable plan, which is a Section 162 kind of plan where you are getting reimbursements. Because what happens with a home office is that, well, one, there's this if you file a Schedule C, which generally recommend not doing because it's not tax efficient and it's higher audit risk than other methods. So, but if you do, there's uh, a home office deduction that you could take. And there's two methods to it. There's a simplified safe harbor method, which they just give you $5 a square foot, up to 300 square feet, I think it is. And then, or you can do the detailed method, which you actually list out all your different expenses and everything, and they do a square footage apportionment. So you can do all that, and to the degree that you have improvements in your home office, then you can take those uh, to the degree that they're related to the home office. So if it's a general thing that affects the whole house, you would just get a percentage based on your square footage relationship. If it's something that's 100% used for the home office, then you would take the 100% of whatever that expense is. And then there's different rules if it's capitalized as expense and all those kind of things. That's a bit more than we have time to go into. Um, so that's one element. Something to think about when you do that is that, if you are doing something that actually improves the value of your house, when you sell it, the residential exclusion doesn't apply to that portion. So that's kind of an extreme case. Usually doesn't matter, but it can. But then if you have a business, the more efficient way to do it is through an accountable reimbursement. So you spend the money on the personal, you get reimbursement from your company for the business use of those personal things. And then you avoid the whole home office thing entirely. You still have the issue with the house improvement if that becomes a factor. But yeah, that's the most tax efficient way to do it. Um, and then depending on what the improvement is, you might, if it's like you said energy improvements, right?
Yep.
So, there's the new 5695, which is the residential energy credit. So the old credit was very limited. It was $500 lifetime and, uh, for kind of usual stuff like doors and windows and efficient air conditioners and stuff like that. And then if you had solar panels or if you had geothermal or something, then you had a 30% credit, which was not limited to $500. But the $500 lifetime credit was, I mean, okay, we'll take it, but it's $500 one time or $200 one year and $300 the next year or something like that. So its usefulness was limited. The new version of the credit, which starts in 23, uh, is they have different categories for things like heat pumps and energy efficient appliances, and there's a whole series of categories, but it is not lifetime limited. So you get it. You can, if you keep making investments in improving energy efficiency, then you can keep getting the credits. Um, Also, there are a lot of local utilities will offer rebates for various kinds of things. Like you can do an energy audit where somebody comes out to your house, says you need to do this, that, and the other thing. They'll give you a rebate for that, or there's a tax credit for it. Um, and so if you buy a generator and if you buy a heat pump and if you buy this and that and you do something every year, then you can keep taking the credit every year because it's not lifetime limited. So those are all things to look at, especially with regard to energy stuff. But yeah, just if you have the entity set up right and you have your documentation set up right, accountable is the most optimal way to take those expenses. And with that, we are at 55 minutes past the hour. So that is all the time for questions that we have. And I know Serena sent me this whole list, and we've got way more.
It's
But
okay.
like you can see on the screen, it depends. And
Mhm.
getting into what it depends on takes a while. So I think that's probably what I hope people take away from these Q&As the most is that it's like, well, there is no blanket answer. It depends. It gets complex depending on what you're doing. Um, and that's why you need some expert consulting, basically, in whatever you're doing. All right. So with the last 5 minutes, I do want to show you guys the next steps. So you know, if you wanna talk to us, obviously you can go to taxsherpa.com. You just click book an appointment, and we'll be happy to talk to you. However, we are busy, so if you want a DIY kind of solution, you go to taxsherpa.com/templates, and that will get you the our planning worksheets. So those are just fill in the blank. There's it's the same worksheets that we use internally to help our clients, and you can go in, you can get a copy of them, and there's video guides in each thing, and you can basically plug and chug your way through it. And I still recommend consulting with somebody because you don't want to do the wrong thing for your particular situation, because again, it depends, facts and circumstances. But you can get those master tax planning worksheets. Along with that, you can get your business Basecamp tax guide, which is, I don't know, 7 or 9 pages that I wrote as far as how to set up your business, how to manage your cash flow, what the whole overall principles of all this is. And you'll also get a tax filing checklist to avoid red flags with the IRS, just things to go through, different individual issues that people that I've seen people run into. So, you do always want to avoid things that are automatically going to generate a letter from the IRS to you, and this will help you check all those things. You get that whole suite of things. It's $7. Less than a cup of coffee at this point. So definitely worth getting there. You can't find that link anywhere on the website. That is a secret link, at least for now. So you just have to go into it and type that in, taxsherpa.com/templates. And then there's an S on the end. And then next week, we're going to do this all over again. Like I said, next week is going to be on the 5 tax tactics to saving $32,846, I think it was. And
Mhm.
that's going to be a case study with a recent client. And you just go to taxsherpa.com/live. That will take you to the registration page for next week. And I've already updated that link. I did that right before we went live here. So usually it's like next morning that I do it, and hopefully I remember. But this time I was proactive. So we are good to go there. You can check that out. And next one will be the 12th at 6 p.m. Eastern, and whatever time that is for you guys locally. And yeah, thanks everybody for coming out. We got a couple comments in chat. Thanks for the show. Appreciate you. And yeah, we'll do it all again next week.
Yep.
Any parting words, Serena?
Hopefully we'll see them soon.
All right. See you soon. All right. Catch you guys.